This is Boom Bust, and these are some of the stories that we're tracking for you today. First up, New York Attorney General Eric Schneiderman filed fraud charges against Barclays over its dark pool, saying that the bank favors high-frequency traders over other types of investors, and now broker-dealers are heading for safer waters. We'll tell you all about it coming right up. Then we're bringing you part 2 of my interview with Mr. Jim Rickards. Rickards is telling us how sanctions, the IMF, and other BRIC nations all factor into the financial warfare landscape. It's pretty intense stuff. And it's the end of the week, which means it's viewer feedback day here on Boom Bust. Edward Harrison and I are addressing your questions, comments, and concerns live on the show. You won't want to miss a moment. Let's get to it. Friday, we'd like to issue a friendly warning. Beware of dark pools, dark ones, especially if that dark pool is located at Barclays Bank. Now, broker-dealers are heading for safer waters after New York Attorney General Eric Schneiderman accused Barclays of allegedly telling its customers that it would protect them from high-frequency traders while actually doing the exact opposite and accommodating those high-frequency traders. Now, Thursday, Credit Suisse, Deutsche Bank, Royal Bank of Canada, and Stanford Bernstein all removed connections from their routing systems to Barclays' dark pool known as Barclays LX. Now, Barclays LX is the second largest dark pool in the U.S. behind the one run by Credit Suisse. Now, the allegations are pretty significant ones, and they include emails from Barclays executives in which they describe decisions to deliberately mislead clients. Barclays' share price fell 6.5% Thursday following the lawsuit. Now, originally, dark pools were private trading venues designed to help investors trade large blocks of stock anonymously. Advocates of dark pools argue that they offer cheaper trading alternatives for investors. Now, Schneiderman's office is looking into whether dark pools operate in a way that is consistent with how they market themselves. That's what's in question here. Now, Schneiderman said, quote, "The facts alleged in our complaint show that Barclays demonstrated a disturbing disregard for its investors in a systemic pattern of fraud and deceit. Barclays grew its dark pool by telling investors they were diving into safe waters, but Barclays' dark pool was full of predators there at Barclays' invitation." Now, what's almost more interesting about this case than the actual case itself is the potential impact it will have on dark pools in the U.S. markets. Now, investigators are demanding more transparency, and the AG's office is also scrutinizing the activities of other major dark pools, including those run by Goldman Sachs and Credit Suisse. The lawsuit against Barclays is asking the court to order the bank to halt its current behavior and pay unspecified damages. But will that really solve the problem of dark pools? That's the question on deck. Now, if Barclays pools go away, there's still plenty of other banks out there with their own dark exchanges. So what will shaming Barclays actually really accomplish? Now, I'm not exactly sure I have the answer of how to fix the problem of dark pools, but I'm also not confident that Eric Schneiderman does either. I guess today, some action is better than no action at all. That up. Pretty crazy stuff. Financial warfare is the use of capital markets as weapons to increase one country's strength and weaken another country's strength. Now, last week we spoke to economist and author Jim Rickards, whose latest book, The Death of Money, is all about financial warfare. And today we're bringing you part 2 of that interview, where we explore how sanctions, the IMF, and other BRIC nations factor into the financial warfare landscape. Now, I first asked Jim if sanctions count within the tools of financial warfare. Here's what he had to say.
There's sort of a gradient, if you will, between traditional financial sanctions and financial warfare, although a lot of the tools are the same. You go back, we've had financial sanctions for decades, and they're often trade-related. Someone's putting on an unfair subsidy, so we'll put an import tariff on something, or ban certain goods, so those kinds of things. And then you sort of ratchet up from there to isolate countries like North Korea, so they can't trade or earn hard currency. So those kind of financial sanctions have been around for a long time. But where it's sort of being dialed up a little bit is in where it's in conjunction with purely geopolitical, strategic confrontation, as is the case with Russia. And sure, there's a whole sort of menu that at the low end, you ban people from travel to the U.S. Like I say, a few oligarchs maybe can't go to the Super Bowl. But at the high end, you can take the largest banks in any country and kick them out of the dollar payment system. So the two biggest banks in Russia, for example, Sberbank and Bank or VTB, it would be very crippling to them and by extension the Russian economy to kick them out of the dollar payment system, even more crippling to kick them out of SWIFT, which is the international payment system based in Brussels, in Belgium. Then they couldn't even move euros or yen or Swiss francs. Actually, one of the greatest threats, and one that Vladimir Putin is taking seriously, would be to order MasterCard and Visa to discontinue their operations in the Soviet Union. Then that would really hit a street level. It's one thing to kick a big bank out of a big payment system. That is crippling. But if the average Russian, goes to the store and can't use her MasterCard or Visa, that's something that would actually affect Putin's popularity. So, but Putin has responded to that. He's setting up his own payment system. Maybe in 5 years we'll look back and see that, Russia has its own equivalent on MasterCard. MasterCard and Visa are going to be caught in the middle increasingly in this struggle.
Yes, that's very interesting stuff, and I'm glad that you bring up the Visa MasterCard issue. But I want to ask you, what about multilateral institutions such as the IMF? Now, doesn't the fact that there are actual vehicles for creditor nations to extract as much payment from debtor nations as possible make them tools of financial warfare?
Sure, and the IMF is a really interesting case, Aaron, because it's one thing when the U.S. and Russia want to square off on a bilateral basis, or recently, Russia was kicked out of what was the G8. It used to be the G7, then they added Russia, made it the G8. Now it's back to the G7. So the G7 recently had a summit, and Russia wasn't invited, except that there were other things going on, and it was actually the commemoration of the D-Day invasion on June 6th. And Putin was there in connection with the D-Day activities, and he met with all the heads of state. I mean, he met with Merkel, he met with Hollande, he actually met with Obama. So I call it the G1 plus 1 plus 1 plus 1. I mean, so Russia's simply too important, too powerful, too big to ignore. So some of this stuff is symbolic. And then kicking Russia out of the G7 is one thing, but you can't kick them out of the G20, you can't kick them out of the BRICS, and you can't kick them out of the IMF. So they still attend all those meetings, and they should. I mean, it's a very important economic power. But it shows there are limits on this kind of thing. I've said all along that the U.S. would not escalate economic warfare beyond a certain level, because Russia's ability to strike back is very potent. We kicked them out of the payment system. Well, they could freeze U.S. assets in Russia. They could dump their holdings of U.S. treasuries, increase interest rates, pop our stock market bubble and our housing bubble. And then an even more sort of covert or dirty level, if you will, use hackers to shut down the New York Stock Exchange. So this can get ugly. I think the U.S. understands that. So you're back to the old Cold War paradigm of mutual assured destruction. Nobody wants to escalate too far because there'll be blowback on them. So the weapons are potent. They're actually more potent when the U.S. aims them at a place like Iran, which really can't fight back very well, but Russia is very capable of fighting back.
What threat do Russia and China pose to take down the U.S. financial system?
Well, you have to distinguish between capabilities on the one hand and intentions on the other. Very little doubt that the capabilities are there. But by the way, the U.S. is not passive in this. The U.S. has the same capabilities, and that again goes back to this mutual assured destruction idea I mentioned. The other analogy we used during the Cold War was, two scorpions in a bottle. So one scorpion stings the other. The victim's going to die, but has just enough strength left to sting back, and they both die. So Russia would refrain from unleashing its hackers to disrupt the U.S. financial system because they know that we could probably do the same thing to them, although we have a lot more to lose. That's an asymmetric threat right there because Russia shuts down the New York Stock Exchange, we shut down the Moscow Stock Exchange. Well, the whole world is disrupted, but who wins? I would say Russia wins in that scenario because we have a lot more to lose. But neither side really wants to go there, Aaron, and that's why I don't think it will go very far. Now, one of the risks is that for some reason it does go that far because people haven't really thought about the game theoretic structure in which you need to understand these issues. But the other risk is an accident. If you have all these capabilities and you're upgrading a software package and you're malignant hacking capability to shut down a foreign stock exchange, and somebody, you know, loads the wrong code or pushes the wrong button, and suddenly it goes off by mistake. That was actually one of the greatest fears during the Cold War. Is not that Russia or the U.S. would intentionally launch missiles, but that having the capability, something could go off by accident.
Can you interlink this discussion on financial warfare with your view on reserve currencies?
Sure. You know, the dollar is the leading reserve currency. It's 60% of global reserves, although that's down from about 70% of global reserves in 2000. So in the last 14 years, the U.S. global reserve position has been drawn down from about 70% to 60%. You know, no doubt that the dollar is leading reserve currency today, but if confidence in the dollar is weakened, either because of Fed policy or the kind of issues we're talking about, financial warfare, people are going to look for other safe havens. I would say gold is number one. The euro is another one, and you know, as I've said all along, the euro is down a little bit because of recent actions by the ECB, but not that much, and I think it's found a floor and probably go back up again. So the euro is one of my favorite currencies. So that's an alternative. So you know, you have gold and the euro out there. Now the real alternative to the dollar, it's not yet taken center stage, but I expect it will sooner than later, is the special drawing right, or the SDR. This is a kind of world money printed by the IMF. It's not backed by anything. It is just like any other printed money, like the dollar or the euro. You're not going to see the SDR right away. It's being held in reserve for a liquidity crisis. The SDR has always been a liquidity tool. If you have that kind of heart attack spike in volatility and there's a liquidity crisis, the Fed will not be able to ride to the rescue because they already did that. They printed $4 trillion the last time. What are they going to do, go to $8 trillion? I mean, there's a limit on what they can do. So in that situation, the global liquidity is going to come from the IMF by issuing SDRs. And at that point, you're going to need China and Russia and these other countries to go along, and they'll begin to insist that the SDR replace the dollar.
Where do the other BRICS, Brazil, India, and South Africa, come in here?
Well, of course, they're not nearly as large. You know, China's the 500-pound gorilla, if you will, and Russia is the second largest member of the BRICS. But, you know, Brazil's a very large economy, and as is India, and they're both got good growth rates. You know, South Africa is a lot smaller. South Africa was probably included in the BRICS more for political reasons than economic reasons. It's a strong economy, but it's quite small compared to the others. But they're doing their own thing. I mean, they're building a BRICS internet backbone. It's going to start in Brazil, go across to South Africa, loop around to India, then China, and then connect to Russia at Vladivostok. I'm not saying that you know, the U.S. intelligence community couldn't tap into it. They're pretty good at that, but it will give them some independent capability. They're building their own development bank. They're building their own reserve bank. Basically, what the BRICS are doing, they're replicating the IMF governance infrastructure. Now, the reason they're doing that, they actually don't want to do that. What they want are more votes from the IMF. They want China, for example, is 10% of global GDP, but its IMF vote is closer to 5%. So China's saying, hey, we need more votes. There are other countries like Belgium, Netherlands that have too many votes relative to the size of their economy. So that battle is going on behind the scenes in Washington at the IMF. So the BRICS are saying, look, give us the votes, and we'll play ball with the IMF and weaken the relative position of the U.S. But if you don't give us the votes, we're prepared to go our own way and replicate these institutions. So it's a little bit of a two-track strategy. But, you know,
that was economist and author Jim Rickards. Time now for a very quick break, but stick around because when we return, we're bringing you the best of the best from this past week. And it's the end of the week, which means it's time for us to hear from you. Edward Harrison and I are tackling your viewer feedback in our weekly Accrued Interest segment. Plus, remember, you can see all segments featured in today's show on YouTube at youtube.com/boombustrt and on Hulu, hulu.com/boom-bust. Now we gotta go, but before we do, here are a look at some of your closing numbers of the bell. Come on back with us.
Are you like me? Do you want your comedy news with some teeth? Want your comedy news to be a bare-fisted, no-holds-barred fight to the death? like a truth vampire biting into the necks of the corporate elite and the billionaire freaks while they're going, make it stop! Well, that's what you get with my new show, Redacted Tonight.
Is that too much? I think that's too much.
What are your thoughts on what's been going on in Washington?
Well, it's a mess, Larry. I mean, the whole country is being scoffed at and laughed at.
Enough is enough.
The media, the candidates, the corporatocracy, covering issues that actually affect you and me doesn't do too much for ad revenue.
Biotech agriculture giant takes on a 76-year-old American farmer based in Indiana.
How much fallout do you think this is going to create for the CIA?
Do you think this is what's triggering the crisis?
America's the largest economy in the world. It's also the largest debtor nation in the history of the world.
Breaking the set is mostly about alternatives to the status quo, but one that gave real alternatives a voice.
One minute they were working toward the American dream, the next they were just trying to survive the night. It's time for Americans and lawmakers in Washington to wake up and start talking about the real causes of poverty in America.
I would rather ask questions to people in positions of power instead of speaking on their behalf. And that's why you can find my show, Larry King Now, right here on RT. Question more.
Welcome back to the show. Now, it's the end of the week, and that means it's time for our Best of the Best segment. Now, first up, we have Catherine Austin Fitz explaining how we're undergoing a paradigm shift toward a networked economy. What's a network economy, you say? You got to watch to find out. Then Divya Narendra discusses the dangers of depending on Twitter for investing information. He says don't do it and explains why it's an unreliable tool. And Cullen Roche weighs in on inflation, Federal Reserve policy, and the U.S. macroeconomy. Then Marshall Auerbach gives us his take on former Treasury Secretary Timothy Geithner's bank-centric response to the financial crisis. And rounding out our best of the week, currency expert Mark Chandler explains how our low volatility environment makes trading in FX markets especially difficult. Enjoy.
Two things are happening. One is we're taking digital technology and integrating it into the basic infrastructure and hardware of life. And as that happens, we're seeing more and more flow, whether it's media flow or financial transactions, shifting onto the internet and online systems. A big part of this, Edward, is the fact that we now have almost 3 billion people and rising on smartphones. So we are moving from a world where it's not North America, which is the biggest consumer market. It's not European Union that's the biggest consumer market. It's people on smartphones who are the biggest consumer market. And it's having a very dramatic shift in both cash flows and the whole marketing presence of all sorts of activities and organizations. So it's this shift that comes with the integration of digital technology into everyday life. And it's not just online systems, it's the integration of technology into hardware. So we're seeing, I call it the digital heartland. I'm based in Tennessee, and if you come out into the middle of the country, you're literally seeing this kind of technology integrated into the basic infrastructure. So technology is no longer something that just happens in Silicon Valley or around Boston. It's happening in the trains, it's happening in the trucks, it's happening in the cars, it's happening in the day-to-day infrastructure of industry, from farming to everyday walks of life.
Personally, I think Twitter is a dangerous tool to use or to rely on for investment purposes, simply because there's so much. The number of tweets are, we're talking billions of tweets. I mean, of that, some subset is going to be directed towards financial commentary, and then of that, I think a very small subset is going to be coming from individuals who have real credibility within the investment world. And I think you know, I have come across, you know, other people and companies that are trying to make sense of kind of all the financial commentary that's actually on Twitter. But it's dangerous because there's, you know, there's a big credibility issue, and there's, you know, you want to be able to filter that, all of that data in a sensible way, and I think that's a lot harder than some people, you know, might think it is.
I think it would be a big mistake for the Fed to assume, again, that this is a very rare economic environment. This is not your, you know, your 1990s, this is not your 1980s, and this is definitely not the 1970s. It's a very unusual economic environment where we're coming out of a credit crisis. It's entirely unique, and so I think the Fed has to view this as its own environment. And you know, in a situation where we have, for instance, the U6 unemployment rate at over 12%, and, you know, you have still inflation is, you know, that the core rate is still about 2%. I mean, this is an environment where you have a huge amount of slack in the economy. And when you have that sort of slack in the economy, it would be very unusual to see a demand pull inflation that is sustained, I think, for several quarters or several years. And so I think that although some of the inflation numbers have ticked up late in the recent data, I think it would be a big mistake to assume that this is something that's going to become sustained going forward, just because, you know, although things are getting better, we're still in a very, very sort of tepid and weak environment. And I think that if the Fed were to tighten sharply, I think that you could easily see a reversal of some of the positive economic trends that we've seen.
He is right that banks play a vital role, but I think he sets up a false dichotomy, and he's persistently done this from all the time that he was in office. The notion is not bailouts of the kind that we had versus not doing anything. Nobody said that you should just, except for the most extreme libertarians, that you should just let the banking system go. But there were other alternatives. We used other alternatives in the 1930s. We nationalized and restructured a series of banks under FDR. The Swedes and the Norwegians did the same thing. So there was no reason why we couldn't actually downsize the banking system, protect the depositors, and actually do loads of FDIC-style restructurings on all of the banks. That would have been a much better way to go. That option was never accepted because I think Geithner, like many of the other Reubenites, was too enthralled to the ideas of Wall Street and therefore never considered it seriously.
One kind of interesting characteristic of the foreign exchange market now, which makes it difficult for your viewers as well as our clients at the bank, is that volatility is just very low. I sort of draw the distinction between like playing squash and playing racquetball. I play racquetball, the ball bounces around more. Where you lack in skill, you can make up with finesse and speed. That's volatility. But we live in a low volatile world right now, and that's much more like squash, where you need skill, not just luck and finesse. And so I think that's what the capital markets are now, and they're record low volatilities in the currencies, in the bond markets, and the stock markets. And I think it's just very difficult for investors to really earn that alpha.
That was our best of the best from this past week. Time now for your weekly accrued interest. Interest time with Edward Harrison. Now, every Friday, Ed and I put you, the viewer, into the driver's seat, letting you steer the show with your comments, questions, and concerns, all sent to us throughout the week via Twitter, YouTube, and Facebook. Let's dive right in. Capitalist, a frequent writer and someone we enjoy, writes to say, the data supports an improving economy. Unemployment is coming down, and U.S. manufacturing PMI is increasing in recent months. Colin is right. Everyone is looking backwards instead of looking at the improving data. Now, Ed, is Colin right? Is everyone looking backwards instead of looking forwards at the good news opposed to the bad?
They are, definitely.
Yes.
And, you know, here's the thing. I want to go and take a deep dive into this one, the whole thing. And the reason is because I think that you have to separate the secular from the cyclical. Because basically, when you look at what's happening in the economy in terms of what just happened and what's going to happen into the future, you're looking at sort of the cyclical trends. That is, you know, what's happening in the jobs market, what's happening in terms of wages. You're looking at, you know, what's happening in terms of production, things like that. And the reality is when you look at all the forward indicators, they're all going up. And what that means is that what we saw in Q1, which is a negative 2.9%, decline in GDP on an annualized basis, that's really somewhat irrelevant, okay? What's really important is what's happening going forward.
Okay.
Now, the two things, the caveats to that are, number one, how is it possible in the midst of what people are calling a good recovery that we're going to have minus 2.9% annualized growth in one quarter without something being seriously wrong?
Right, yeah.
You can't have it all be weather-related stuff that's happening there. Obviously, there must be some underlying weakness that's associated with that. And that goes to my secular point, which is the fact that we have low wage growth, we have huge amounts of private sector debt, especially in the household sector, and at the same time we have very low policy space in terms of fiscal policy from a political perspective, as well as monetary policy, because monetary policy is already at 0%.
Yeah, exactly.
You can't go any lower than that.
Follow the ECB?
Right. So,
yeah.
If any of this unwinds on a cyclical basis, you have a really negative backdrop from a secular perspective, which I think means you're going to get more deleveraging, you're going to get a very nasty downturn, and the next recession is not going to be pretty.
Okay.
So that's my sort of holistic view of the whole thing. It's not just about the cyclical. The cyclical looks good, but on a secular basis, I still think it's a very murky picture.
Blammo, you hear that? Now we know. Murky picture. Thank you, Ed. Good to know. Now, another remark. This one comes from Machuda. Machuda writes, regarding international reserve and trade currencies, it does not have to be all or nothing. Imagine a future where multiple currencies are used for international savings and trade. Why switch from one dominant currency to another? Why put all of your eggs in one basket? Ed, this is an interesting take. What are your thoughts on this?
So, the whole reserve currency thing is interesting because, I think the French at once, they talked about America's exorbitant privilege in terms of having a reserve currency. And it allows us to basically, get away with a lot of things that other countries couldn't get away with in terms of current account deficits and things of that nature without it, because there's always a bid for the US dollar since it's the reserve currency. But the truth of the matter is that there's no one on the horizon right now to replace the US dollar. So when people talk about reserve currencies, what do you see? I mean, you got the euro. They're having their problems, right?
Yes, there's lots of problems, but some people will argue that there's arguments for other currencies as reserves. I know it's a long shot, but they can say renminbi, they can say euro. There's other things out there, no?
Yeah, you can use those in part, but I mean, their economies aren't at the same size. There's not the same liquidity in their markets and their credit markets. The sterling is too small. Swiss franc is too small. Over and above the dollar, I mean, there's nothing else.
Yeah.
So I think that the concept that we're going to move away from the dollar over the long term, yes, but over the short term, not at all.
There, you hear it. Long term, yes. Short term, not at all. That's all for now. Please check out our Facebook page, facebook.com/BoomBustRT. Please tweet at us at AaronAid, at EdwardNH. From all of us here at Boom Bust, thank you for watching. Have a fabulous weekend. Bye-bye.